All right, I'm Michael Hartzman. Today is Tuesday, November 11th, 2025, and I'm on as always with my partner Dominick Tavella. How are you how are you, Dom, tonight?
I think both of us are just cold, Mike. We are in the New York tri-state area, but the country overall is going through a little bit of a freeze. So here's our first taste of winter, and maybe by the same analogy, so is the markets. Maybe the first taste of winter and what the markets are doing right now.
As always, an excellent segue. But before we jump in the show, I know we both want to wish all the veterans out there a happy Veterans Day. And thank you for your service. And you guys definitely deserve more than just one day. But happy Veterans Day to all who celebrate.
Sincere thank you and a pat on the back for sacrifices and a job well done.
Absolutely, including our dads, I might add.
I had a grandfather who served in the U.S. military, so history goes quite a far back.
Yeah, my dad was in the tail end of World War II. But jumping into the present day and jumping into the market, I'm going to ask you a loaded question in a minute. But first, let me just do the update, the numbers, if I can. Through this past Friday, I believe November 8th, the S&P Dom is up 15.6% for the year. The Dow was up almost 12. The NASDAQ was up 19 and three quarters, and the EFA, the MSCI EFA index, leading the pack at 26.25. Oh, and I would be remiss if I didn't mention emerging markets. They're actually leading the pack, up 31 and three quarters percent. Last week, I wouldn't call it an ugly week. It was not a pleasant week, but we've seen weeks like this before. The S&P was down 1.6, the Dow was down 1.2, and the NASDAQ was down 3%. As you know, the NASDAQ is tech heavy. So, Don, the loaded question, there's a lot of things that we could always worry about. Some are short term, some are long term, some are headline risk, some are legitimate. So I'll ask you, my friend, what are you worried about right now?
Well, the two issues, and I think we'll have an opportunity to get into it this evening, that really, to me, are at top of the leaderboard here. One, are we really in a tech bubble? Do we have a overvaluation in a very, very concentrated number of stocks? And I think what happened last week is a reflection of maybe some concerns there. And then, Mike, one that maybe finally might get resolved. We've discussed it in our past shows. Is this government ever going to reopen? And for the most part, most Americans haven't really noticed, other than now we're seeing the travel delays, the air traffic controllers. It's starting to affect the economy. It's starting to affect the general public. And up until now, kind of unnoticed, but it's starting to hurt now. And will this government finally open? It looks like we might have a light at the end of that tunnel. So I would say those are the two big issues of worry right now on our leaderboard.
You know what? As always, I completely agree with you because I came up with 8 things. And the top two were the AI tech bubble and the shutdown, because I feel like the other six we talk about all the time. So let's tackle the shutdown first, because we may not be talking about that again next week. You may be right. And this is the longest shutdown in government history. And you're right, for the average American, it is the air travel that has had immediate impact. But I think on a more humane level, Dom, I think it's this SNAP program, and people literally, having food insecurity is what may have moved. And we're not a political show, but that may have what moved some Democrats off of their stance to get people, the food benefits that they desperately need.
Yeah, Mike, and again, we're keeping our fingers crossed. It looks like the two parties have come to an agreement. They're scheduled to reopen the government, I think, by the end of this week. But we've talked about this quite in depth. That real people are being harmed, whether it's the food stamps program, people not being able to get their benefits there, or obviously the air traffic controllers and many other departments that basically were shuttered with the lack of paychecks arriving. So it looks like that may be resolved in the short run, and I'll say good for the average American out there. But I hate to say a pox on both houses that this should have gone as long as it has.
Yeah, I think it's very rare that anything is bipartisan in the country, right? And I think the entire country would agree with the sentiment, pox on both houses.
Yeah, listen, we each have our own political views, but when you have politics getting in the way of real people being able to put food on the table, real people being able to pay their mortgages or rent or car payments on time, come on, we should be better than that. So again, I'm not going to even muster an opinion on who's to blame for this, other than we never should have gotten to this point, and
Yeah.
I'll leave it at that.
All right. So let's move on from there and let's go into really our wheelhouse, and that's the market. And so look, in my opinion, this is not 2001, right? The differences are stark. That's number one. Number two, the market has had a great run, not just this year, for the last several years since 2023. It took a breather in 2022. The NASDAQ's been on a great run for a long time now. The NASDAQ was up prior to last week over 20%. It took a 3% breather. I would argue that's good. It's healthy. I understand the warning signs of the tech run up, and is it real? But I do also think, Dominic, that a part of this phraseology is to put eyeballs on newspapers and television screens.
Look, and we know this one firsthand. Good news doesn't sell. Bad news is headlines and people watch, right? But I think we can take a moment here and kind of maybe do a side-by-side comparison, what happened 97, 98, 99. And Mike, you and I lived it, right? Part of what scares me is many of the people in our industry today literally were not in the industry back in 97, 98, 99. If that makes you and me dinosaurs, I'll accept it. We're dinosaurs. I get it. All right. But it doesn't mean that what we have to say isn't valid. In 97, 98, 99, we had companies that literally made nothing, had no earnings, no profits, no inventory, and the valuation was sky high. Eventually, that whole basically fake house of cards collapse, and that was what happened in 2000 and 2001. This is not that. This is definitely not that. The companies that are integrally involved in the AI are real companies. They make real money. They're using, for the most part, a lot of their own capital to invest in artificial intelligence and how it may be used over the next coming years, 5, 10 years. They're making real investments. Where I do think it does compare to what happened in the 90s is that we don't know who the winners and the losers are going to be. And I can argue that in 97, 98, 99, the companies that went through the roof in terms of valuations are not necessarily the companies that survived after the collapse, right, Mike? And the companies today that most benefit from the internet and technology didn't even exist in 97, 98, and 99. They profited from the infrastructure that was created in the 90s. The companies today, will they be the companies that profit most in the next 5 to 10 years, that take advantage of the infrastructure that artificial intelligence created? Will those companies even exist? Will new companies sprout and they will be the dominant resources? We don't know. And that to me is the real question. Who will the survivors be? Who the losers will be? And it's an unknown right now, Mike. Sorry about the long answer.
Oh, it's a great answer. And look, I know your favorite example of that period is a made up company made up by you, garbage.com. I've heard you say it 1,000 times,
Yeah.
right? We don't buy garbage.com. My favorite example was drcoop.com, which, by the way, was a real company by the Surgeon General. With that, I don't remember what they did. And look, and the expression back then was the burn rate. How quickly were these companies burning through money? And it was based on debt. This buildup is based, as you said, on companies' earnings. We were in the room at the same time when we had that pointed out to us by other analysts smarter than us. But the other thing I would say, to your point, is we're not going to know who the winners or losers are for several years. That's number one. So to call it a tech bubble now, when we don't know the answer to the winners of the race for at least 12 to 24 to 36 months, I think is a little bit, at least a little bit overblown. That's number one. Number two, Dominic, all we hear about is a Magnificent Seven, right? And they're spending, you say it, trillions of dollars, right? But whatever, it's an insane amount of money that they're spending. But the point is, they're spending it on other companies. So this opportunity is not limited to the Magnificent Seven. It's the data centers. It's the builders of the data centers. It's the rare earth minerals. It's the quantum computing. This money is going somewhere. And I think it's a relatively good sign that these companies are spending this money and it's being spread out. The opportunity is spreading. And I think that's a positive.
So I want to make two quick points, Mike. The first is if we go back to 1999 and 2000, a company like Apple was barely functional, right? It barely, I mean, some people will argue that at least on paper, it was basically bankrupt. Obviously, they pulled themselves out of the ashes, and today it is just a mega one of the sevens, right? Phenomenal company. But back then, you would have looked at it and go, I don't know if this company will be in business a week, a year from now. A company like Google and then Facebook and turned into Meta didn't even exist during that time. They came out of the ashes. So some of the companies today that are just the mega seven, right, either didn't exist back then at all, or for all intents and purposes are reinvented themselves. This is what I mean by we don't even know who the winners are going to be a decade from now. The flip side of that, Mike, is some of this burn rate discussion is actually happening today, where companies are taking in billions, if not trillions of dollars. Think of OpenAI, which is not a publicly traded company. They are burning through, round numbers, depending who you believe, $100 billion a year of this capital that's coming in trying to develop their platform. Now, hopefully they develop it, they'll be intensely profitable, but not likely to be profitable anytime in the near future, Mike. And so again, all this money going in, will any of these companies see a return, a profit on the investment they're making?
I agree. Look, and that is an ongoing question. How are they going to monetize this? But I don't think it's a late 2025 or a 2026 question. I think it's a 2027 or 2028 question. I guess that's my point.
And to that point, Mike, last week was a little bit, just a tiny bit of investors going, hey, is this company, and I don't want to pick any specific names out loud, but are they going to get a return on their investment? Is their capital expenditure being a prudent one, careful one? When will they see a profit on this? How long are they going to have to wait? Are they making intelligent investments in artificial intelligence, right? Are they making wise investments? And I think this is healthy. I'm not startled, surprised by last week's numbers. And if it got a little worse, not terribly shocked. It's good. It's healthy that investors are asking maybe not dumb questions, Mike.
Yeah, look, 3 weeks ago, and I'm going to do what you did. I'm not going to name names. But OpenAI made an announcement. They were investing in two fairly large companies, not the Magnificent Seven, but two fairly known names if you watch the tech sector. Both of them, Dominic, went up 40% in a week. One stock that I watched closely was up $80 in a week. I think it's perfectly healthy. I think it's refreshing that if it went up $80, it gives back 10 or 15 of it. So I would argue, so what? And to me, what's frustrating is why do sell-offs have to be labeled? As the old expression goes, why can't a cigar just be a cigar? Right? I mean, why do we have to label it at all? Why can't it just be profit taking?
Look, we come back really where we started, Mike, that headlines sell. So we turn on the business channels every day, and we're looking at the news every day, and we're listening to portfolio managers every day, and news sells, right? So we have to call it something. I am adamant at this point that, and this is reflects in our portfolios that we run for clients. At this point in the game, a little healthy pullback is not a bad thing. The markets have not fallen off a cliff. We had a little bit of a pullback last week. If it continues over the next couple of weeks, is it doom and gloom, end of the world? We don't see it. We don't see the economic cycle that would put fear in us at this point. If it shows up, we're certainly going to talk about it, Mike. We're not shy in our opinions, especially on this show. We're going to tell it like it is, but so far so good.
Yeah, and look, so we have complete agreement on these were the two most pressing topics, the most timely topics. So now I'm going to give you the other six on my list, and dealer's choice. You could pick the one you want to talk about first. But these are the ones I came up with.
Throw the next one in, Mike. Throw it out. We'll see
right.
where it goes.
So I came up with inflation fears, recession fears, interest rate fears, overvaluation of the market, job market slowing down, the economy slowing down. Take your pick.
I would say take the top one and we'll walk our way through it, Mike. We are, in all fairness, and I think it's good that you and I do these by ourselves sometime. Mm-hmm. We are basically almost through the entirety of the year. What do we have? Like another month and a half to go here, Mike. So some of the things we've talked about all year long, and we can go right back to January. Now we kind of have a better picture of the reality of our opinions, right? So let's hammer one at a time. Let's go for it.
All right, so inflation. It's not 2022. Inflation's ticked up a bit, right? A bit. But and I'm gonna bring the news media back into it again. A week and a half ago, or it was a week ago today, actually, we had the election, right? So I had a channel on a few days earlier, a news channel, one you never watch, I can guarantee you that. And they were talking about the economy being a dumpster fire, right? A dumpster fire. And this is why I spend most of my time watching sporting events. Because I was just channel surfing, I promise you. I just spent a long time there, Dom. I don't want to lose, I don't want you lose faith in me. But the economy is not a dumpster fire. Are things more expensive? Yes. Are people of lower income stratus suffering? Yes. That's been going on a very, very long time. But the reality of it is inflation's getting a little worse, but the economy is not on fire.
Yeah, so I'm going to go literally back to January, and somebody can hold our feet to the fire. We said inflation will be lower by year end, but not substantially, that it would be stickier than some people had assumed.
Mm-hmm.
And for a multitude of reasons, which we've discussed quite a bit on the show, that's pretty much the way it's going, Mike. Now, it may slightly tick up, and some people want to blame tariffs on that. Some of the costs that companies have assumed because of tariffs, they're trying to pass it on to as much as consumers can stand. But the truth of the matter is consumers can't stand very much of it, and they're quick to adjust their budgets. And so, yes, prices have ticked up slightly, but not anywhere near as dramatic as some people out there had said they would. Companies have done a good job of using savings that they've been able to muster on one side of the balance sheet. Think of energy, think of cost of labor, and they're using those savings to offset some of the higher costs. So for the most part, it's in line, slightly worse than we had hoped for, but not dramatically. And by no measurement we've seen, and I come back to this story, recession slash economy in a dumpster fire. We certainly were in meetings in January where there was anywhere between a 40 and 60% probability of a recession. That is completely off the table. The economy is holding its own, and recession is in nobody's call at this point in the game.
And just for the record, you and I did not think we were going to have a recession.
No, we didn't see it, and I'm not sure that was on your list, Mike. But consumer spending has really held up extremely well. Again, the portion of the population that does have a job, has a paycheck on Friday, has some earnings, looking at their 401ks, they have not slowed down their spending. And
yeah,
there's
I'm glad you said that, because tariffs and the consumer were not on my bingo card. But let's talk about the consumer for a minute. I think one of our advisors said this morning that, Christmas spending for this year is going to be through the roof, right? So yes, part of that might be higher prices, but if people have job insecurity or can't make ends meet, I don't know. You said it best from Dr. Kelly, that we have an amazing propensity to spend money in this country. So
even if we don't have it, Mike, we will borrow it. We will use our credit cards, but we have an amazing ability to spend money. But you did bring up an extremely important point. Having it and spending it are two different things. So if we were to have a fear moment, I think your point is extremely valid. If we have a fear point, people will hold on tighter to those dollars, right? So it has to be an event, and God forbid we don't want to see that happen. But at this point in the game, we think we go through the end of the year with not a dramatic decrease or reason for a dramatic decrease in spending. And that will hold up the economy.
I said it this morning, I'll say it again. I said it before, the consumer is the gift that keeps on giving to the stock market.
Yeah, to the economy, and that's the definition of the stock market. Yeah.
Yeah, I mean, they just, as we have an amazing ability to, spend on things we need and spend on things we don't need frequently.
And then more often than not, stuff we don't need. But that's a conversation for another day. But let's tie it to this conversation into one of the things on your list, which was the employment numbers.
Yeah, but there's been 2 jobs. Yep. Go ahead.
So the government has been shut down, right? We know this pretty obviously. And we have not been getting government data on the employment numbers. So we don't know on a big picture, we don't know how the employment numbers look like. And the numbers we will get once the government opens are probably going to be skewed, Mike, right? But we are getting private market, private company data through ADP, which runs a weekly report. And that number has been showing significant slowing in company hiring. So there's a data point we might be able to hang our hat on a little bit on what's going on in the employment data. So I'll let you maybe spend a few minutes talking about it.
Yeah, so look, the job market is clearly slowing down, but again we pointed out this morning, while there's not a whole hell of a lot of new jobs being created, there's also not a whole hell of a lot of job being destroyed, right? So employers are holding on to employees, right, tighter than ever. So maybe the cost of labor is going up a little bit. So I feel bad for young people who are looking for a new job in this economy, but I think overall the unemployment market is staying relatively stable, and I do think you're right. Once we get the data for this month, it will be skewed because of the shutdown. Because the shutdown doesn't just affect the person who's not getting paid; it affects other businesses and other people around them, especially in a state like Virginia, right, which has a lot of government employees. So I do think we have to take the jobs data for the next month or two with a little bit of a grain of salt.
Couldn't agree more. And just to kind of emphasize a point you made, Mike, the good news is that small businesses are responsible for most of the hiring in this country. So the good news here, the glass half full, is they are not really laying people off in a significant manner. We've had a lot of announcements for layoffs, but generally speaking, those are the bigger companies. And even though, we've heard numbers from UPS and we heard numbers from Amazon, which are pretty large, but in the context of the total number of people they employ, it hasn't really moved the needle. Sorry for the people that got laid off, but not in terms of the overall effect on the US economy. So small businesses, medium businesses, they're holding on to their employees, but they are being very, very careful about new hires. So that's the good news, bad news on the employment number, Mike.
Yeah, and I guess that dovetails into the economy and the market at all, overall, and going back to what we started the show with about an AI tech bubble. There's always a concern that the market is overvalued, right? That prices cannot keep up with the earnings these companies make. And Dom, as far as I can tell, up until now, they have been. The PE on the S&P 500, which means price earnings ratio, is in the low 20s. What's wrong with that? I mean, isn't that kind of the average, the norm?
I'll say yes. And again, the glass half full. The earnings numbers so far this quarter have actually been pretty good.
Yeah.
For the year, they've been very good, way
Hmm.
better than the analysts had estimated. That's the good news. The bad news is it's concentrated. Most of the earnings and earnings growth, shockingly, sarcasm, has come from this very concentrated group of stocks. So the average stocks earnings are not really all that great in terms of their growth, but this concentrated group of stocks has been responsible not only for most of the profits in the S&P this year, but actually most of the earnings this year. And that's not likely to change, at least in the near future. So it's both a good news, bad news story there, but you can't argue that the earnings are real. And for the most part, the market has done very well on an annual basis.
Yeah, and I agree. And I also think heading into 2026, with interest rates coming down, you know, the period of where had very attractive interest rates and 5% returns basically on a riskless investment is basically over. So doesn't that put the boring large cap value dividend players back on the table for 2026?
And let me state again, maybe the obvious here, Mike, for you and me, but maybe not obvious for the people that are listening to us. The high quality dividend paying stocks have been one of the worst performing areas of the market on a year to date basis. People find it hard to believe it. I'll just pick on one because obviously he's considered a genius, but Warren Buffett and Berkshire, negative year to date. If you own that particular investment, if you own the Warren Buffett portfolio, you'd be losing money in a market that's up 15% on the S&P year to date. This is negative year to date. I don't think it reflects on Warren Buffett. I don't think it reflects on the portfolio that he owns. It does reflect that quality dividend paying stocks just have not done well so far this year. But a lower interest rate environment will be beneficial to these kind of companies, along with mid caps and small cap companies. And so maybe that's an area to look at for 2026, where maybe some of the profit taking technology can get rolled over into companies that haven't quite done as well and might do better in a lower interest rate environment.
Yeah, I mean, I do think you could make the case for that reason, and also, we saw a headline this morning: a very large bank out west sold, I think it was a $5 billion position in one of the Mag Seven, and suddenly that's a headline. But that money's got to go somewhere. That money's got to be reallocated for their clients in that portfolio. So you could also make the argument if you're going to take your profits in these companies, the money's got to go someplace, Dominic.
Yeah, and again, it's part of you call them bobbleheads on TV, but we're hearing a lot of the money managers saying, "Listen, don't necessarily sell your large cap tech stocks, right? Don't liquidate them and walk away. You would likely leave a lot of money on the table over the next 12, 24 months. But why not take some profits, some of the gains you have this year, and rotate them into things that maybe might be doing better going forward?" And a segment we've talked about a lot, I love, is the healthcare sector. All of a sudden, Mike, it was negative most of the year. You would have been losing a lot of money. And in the last month, one of the best performing sectors in the S&P 500.
Yeah, so to your point, I'm looking at my cheat sheet, and healthcare is up almost 8% this year, which is kind of out of the blue. You're right. No one saw that coming.
Well, and I will tell you, Mike, if you looked at it on a chart, most of that came in the last 30 days. Right, we went through the entire summer where the average ETF in healthcare was negative 5 to 10%. So it captured back its loss for the year, and I think for the last month it's up about 7%. So
Right.
most of the gain you're describing, best performing sector in the S&P 500, not technology, boring healthcare, boring healthcare.
And so no surprise. I'm going to spend a minute on these sectors. Communication services is up the most this year. Technology is up the second, and a couple of years ago they split up communication services and technology. Used to be one category, now they made it two. Dominic, utilities is third, up 21% this year. Utilities is your aunt's investment from the 1970s, right? Buy me Con Ed. My brother was a financial advisor before me, and our Aunt Lil became my brother's client, and that's all she wanted to buy was Con Edison, right? Who knew that 40 years later, utilities would be the third leading sector? But you know what? It's because of the first two sectors. Because what have we been saying for months now? How are we going to power all this need for all this technology?
Look, you couldn't have said it better, Mike. The average time to build a plant, whether it's going to be a nuclear power plant, which could be anywhere from 7 to 10 years, natural gas, which we have plenty of in this country, it's still a 5 to 7 year timeline to build a brand new plant. So existing power plants, existing nuclear power plants are in huge demand. You cannot run artificial intelligence. You can't run data centers without energy, and utilities have it and control it. So there's a huge demand for power. Utilities are the beneficiary of that demand, and not likely to change anytime soon, Mike, because you take so long to get a plan approved and built in this country.
And let me just point out to you, you used the word nuclear. It rolled off your tongue. It's not a dirty word anymore, because they've made I'm really wandering off the reservation here, but they've made the technology of nuclear energy safer, and it's no longer, a source of energy that reminds people of 3 Mile Island.
Yeah, I'll stay away from the arguments. We went through it decades ago. We certainly had a plant right here on Long Island that was brand new, and they just shuttered it before it did it. They actually started operating, and then they just shuttered it and put it away and mothballed it, and we all are still paying for it here in New York. But the reality is, if you are looking to create energy without climate damage, without emitting carbon stuff that damages the entire planet, nuclear is the cleanest way to do it. So the safety issues, I'll let somebody else come up with good or bad or indifferent. But in terms of being able to power, you need reliable, consistent, and unfortunately, the nature of solar and panels is not sufficient to power these AI centers, data centers. So it's either natural gas, and which emits obviously byproducts that's considered bad, or nuclear. So the problem is either one, you want to build a brand new plant today, it'll take you 5 to 10 years to get it up and running. And
Yeah.
so the existing facilities are in huge demand and profit centers for those businesses.
Yeah. I mean, we had a guest on probably 6 or 7 months ago from New York Life who talked about this very subject and basically said, we do not have enough energy to power all the demand that this country has, um, for the computing that goes on.
Yeah, and Michael, without again naming individual companies, but literally a company today that is very much at the center of this discussion was not able to meet its revenue needs, and I think a large reason was they were not able to get the power online quickly enough to meet its demand. So this is an issue going forward, and not one likely to get resolved anytime soon, which is positive for these utility companies, not positive for the consumer and not positive for the data centers, but it is positive for utilities.
Yeah, well, I think the data centers, they need this energy, right? They could build these buildings if they can't power them, then what's the point?
Yeah,
So are they being are they kind of hand in hand at the
they
moment?
are. But again, does that mean they can get it up and running in a year? Not if you don't have the power sourced to be able to do that. So the good news is a good news, bad news story again. The ones that are really up and running quickly and in the construction cycle, they've sourced the power and guaranteed the power to come in to be able to do that. In terms of new centers to be built, yet to be built, and if you can't source the power, what's the point of building this empty building?
No, I could
Dark building.
I could not agree. I cannot agree with you more. So look, we try to do a show, just you and I, a couple of times a year. So just to put you on the spot, what do you think of 2026?
So we always start looking at this from a pure economic. It doesn't always translate directly into a stock market and how it's going to perform, but we really want to know how's the economy going to do, right? And so I always kind of want to look at the glass half full, and you're going, well, maybe this whole tariff issue will be on the back burner, and we won't have to deal with it as noise almost on a daily basis, right? If we can deal with the interest rate environment, hopefully better, lower interest rates, that should be positive. If we get away from some of these political headaches, that should be positive. We can get consumer confidence, and consumers will continue and maybe augment their spending. So there's a lot on the side of the fence that says, hey, we could be looking at a pretty good, pretty positive economic cycle for 2026. And that, generally speaking, will be positive for stocks. That's the glass half full argument.
And the glass half empty argument is that these stories are going to write themselves. We're going to get a new Fed chief, right? And is
Yep.
it just going to be someone in Trump's pocket that does whatever Trump wants and not what's in the best interest of the economy? I'm not saying whoever this person is will do that or not, but that's a story that you could write right now. We have the midterm elections. We have no matter who the Fed chief is, what's going to happen? What's going to happen with interest rates? And the other one, which I think is a near-term story, and we were remiss to mention, there was a story out late last week that the Supreme Court might actually rule these tariffs to be illegal, or
Yeah, that was going to be my glass half empty story, Mike. So I'm glad you brought it up. So let's just put it out there. Again, we by the time we do this again, maybe we have an answer. But if the people that don't know, there's been a lawsuit. The lawsuit has gone out to the Supreme Court to decide that basically the tariffs that have been imposed by the Trump administration are not legal. So here's the glass half empty, Mike. If the Supreme Court votes that these are not legal, then at least theoretically, the $300 billion that have been collected in tariffs have to be given back. So whether it's to companies, to countries, the money has to be given back. Number one, where do they get the money to do this, Mike? Where does the government get $300 billion to give the money back? And you would think the administration does have a plan B just in case, but it might take some time to implement plan B while they're trying to figure out how to not give back the money from plan A. You could expect interest rate environment and the stock market would be extremely volatile. Oh, it's a polite way to put it, Mike. Over the short run, maybe over a couple of weeks, we could see some extreme volatility in the markets.
And look, something happened over the weekend that was so on brand for Trump. It was like the most Trumpian thing he could do. He announced, we're going to give the tariff money away to lower income Americans, right? So, I mean, look, he's so, love him or hate him, he is so good at getting out ahead of the message, right? And getting out ahead of trying to champion something that's not even part of reality. So he hears this story on Friday that the Supreme Court may rule against him, and by Sunday, like, oh, I'll just give the money away. How could you take it from me? I'm giving it to all my citizens.
Look, again, I'll stay away from the politics, right, Mike? This is pure. Certainly, the Supreme Court vote is not political, but the reaction, I think, is political, good or bad, right? But I will say this, Mike: we are still running what, a 30+ trillion dollar deficit, and at least for now. Up until now, the tariff revenue has been touted as an offset against budget deficits. Hey, this is us getting our fiscal house in order. We're not going to overspend. We're not going to continue to borrow. We're going to use this tariff money to help us get the budget to, God forbid, balanced. So we'll see what comes out of it, Mike. But, I always somewhat jokingly talk about the meteor that comes out of the sky that hits us in the back of the head. This certainly would be a meteor coming out of the sky. We don't know where it's going to land yet. And at least in the short run could give us some pretty significant volatility, both in the interest rate markets and the bond market and in the stock market.
Yeah, I agree with you for a couple of reasons. One, if the administration does lose and this says, well, we're not going to pay these countries back, these countries could be retaliatory again, like they were in April, and start selling their treasuries and start selling their dollars. So you're right. This can create some end of year havoc for both the stock and bond market.
Yeah, and look, we've lived this story many times, many years, where we get into December and the portfolios look pretty good and returns for the year look pretty good. And one of my favorite lines, Mike, and I know you've heard it, many, many, many times. I don't want to give it back, right? I don't want the markets to give back what has, at least on paper, looked to be a pretty good year, whether it's our portfolios or the major indices. Man, we've worked hard all year long to get these dollars on behalf of our clients. We don't want to give them back, but if the meteor comes, then it comes and we'll just deal. And I do think if it does come, it'd be a relatively speaking short-term event, but short-term could be a couple of weeks to a couple of months. We don't want to see that happen.
Yeah, a client asked me today about this very topic, and I said, you know what? To me, this is actually a combination. To me, this was not black or white. This one is gray. It's kind of a combination of headline risk and a real risk. And as you said this morning, can the Supreme Court thread the needle? And if they cannot, I do believe that headline risk becomes real risk.
Yeah, and again, I like to maybe leave the story on a glass half full part. We have tweaked the portfolios a little bit just to prepare, just in case. But it's very difficult to play this game. All your chips in the middle of the table, all out. We never do that with client money. So we've kind of tried to prepare a little bit to cushion the blow should it come. But it would be a little scary in the short run. Let's put
Yeah.
it.
Oh, absolutely. But I do agree with you, just to kind of put a bow on this, that overall for 2026, with about a month and a half to go, I'm fairly optimistic about, the economy and the continued success of the economy. And in my opinion, the economy is not going to roll over and die anytime soon.
It would have to be event driven, as we've said many times, Mike. So we don't have a crystal ball that works, and all things being equal, we have confidence in where the economic growth is going to be and the unemployment numbers and things like that, and it'll all come out in the laundry. But generally speaking, I think I can say for both of us, cautiously optimistic for
Mhm.
2026. I think it can play out to be a decently good year looking forward. We'll do our final, year-end call at some point here, but at least for what we can see today, there's really no reason to predict any doom and gloom.
I agree. So let's end it on that note. So Dom, you are out next week, but I will be back next week with a new edition of the Lebenthal Report. Our guest next week is Chief Investment Officer and CEO of August, our good friend John Eade. So you don't want to miss that. And I'll see you in 2 weeks.
Big fan of John. I think you'll have a great show, and looking forward to hearing it when I get an opportunity.
Safe travels, and we'll see you again next time on the Lebenthal Report. Have a good night, everybody.
Good night, all.